Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Through the Noise. Now, a lot of ink has been used in recent weeks writing about volatility in bond markets, with a big focus being on the rise in long-dated 30-year bond yields across Japan, the UK, and of course more recently in the US. Now, to be fair, this is not a new worry. Fiscal hawks have been quite vocal in recent years about high deficits in many markets, and more recently about the risk to bond yields from inflation. However, given some of the moves we've seen the last week, are we now at a point of greater concern? And to some degree, is the jump in gold prices related? To discuss this topic and more, today I'm very happy to be joined by Ray Heung, who's a senior investment strategist in the CIO office. So welcome, Ray. Thanks for joining us today. As we were just discussing, developed market bond yields have risen quite a bit, and we've seen a steepening of bond yield curves. In your view, what are the reasons behind that, and what could the impact be on other major asset classes?
Thank you, Manpreet, for having me. Indeed, if you look at the bond market, it's actually faced renewed upward pressure on yields. And as you already alluded to, the long-term maturity bond yields has been led by a combination of fiscal inflation and policy concern. And in particular, the UK and US was the major culprit. We observe a very sharp move for the UK bonds yield. For example, 30-year yields actually touched the post-98 highs, and where fiscal concerns are increasing. The 30-year yield actually hit 5.7% before retracing a little bit lower. Now, in the US, 30-year bond yields also once again testing 5%, as the concern over the Fed independence, besides fiscal and inflation risks. So if we are using the US government bond as an example, the widening of the yield differential between the 2-year and the 10-year bond is now at the high of its 12 months average. And also, if we look at the differential between the 3-month and the 30-year the bond yield, it is actually over its 12-month average. So while the momentum can lead to more steepening in the very short term, I think this historical perspective actually led us to believe that the yield curve steepening is already very sizable, and that further steepening is likely to be rather limited. So this view is also supported at the extreme, where we see the short maturity bonds already reflecting market pricing in 4 rate cuts over the 12 months horizon, while long maturity bonds remain capped at that level. But nonetheless, I think, as we have mentioned also before that, the September through October tends to be seasonality weak periods of equity markets. And aside from the bond market volatility that brought to the risk, we also observe investor positioning in some sectors, such as in U.S. communications and China material sector in the equity side, could be describing as demonstrating some sort of exuberance. And in addition, reports of China that may be bringing some cooling measures to its equity market too. So all we can see is that there could be some pullbacks in equity, but we do expect the pullbacks to be relatively shallow. I think this is largely because we still view further rising of long bond yield is likely to be capped. Investor positioning in equities, if we look from a broader perspective, is actually far from extremes, and the fundamental backdrop is actually still quite strong, which is demonstrated by the strong U.S. earnings season. So, in our view, we will be adding on pullbacks. And obviously, we would be reiterating to diversify into non-US equity markets in the pullbacks.
Thanks, Ray. Let me just dig a little bit into the equity side for a moment. You mentioned the Chinese government may be considering cooling measures for its equity market. So against that backdrop, why are you still bullish Chinese equity markets?
Yeah, I mean, first of all, the cooling measure to us is likely to be trying to cool the use of margin financing and also to avoid excessive risk being built up in this aspect. So it is more of a technical measure to avoid excessive short-term speculation activities in our view. But we think the underlying performance of the Chinese equity is actually still quite respectable. As we observe that, about 90% of the company in the MSCI China index have actually reported their earnings in the second quarter this year, and with the earnings per share actually show a growth by 9% year on year. This is supported by about 3% sales growth, and the growth was particularly strong in the communication sector, which we saw around 20% earnings growth. Now, if we look at the earning expectation for the consensus of the MSCI China Index in 2025, it actually has been revised down to 2.4% growth. That, in a view, is reflecting the near-term macroeconomic and trade policy headwinds. But having said that, if we look at the 2026 number, the consensus estimates is now be revising up to show a growth of 15%, which is driven by the ongoing AI optimism and also policy support. Now, we view also that China AI development remains very resilient due to the robust CapEx plans and a very clear policy directive to promote domestic semiconductor adoption. I think one example is that the recent opinion piece offered by State Council on the implementation of AI Plus, and also DeepSeek is now utilizing local AI chips to train their models. These could be potential inflection points in reducing reliance on foreign technology and also mitigating U.S. restrictions. So this is our basis to be constructive and opportunistically bullish on China tech. And especially with the potential cooling measure in place, we think the offshore Hang Seng Tech Index will be the ideal candidate to play this theme, as we think the cooling measure is likely impacting more the onshore Chinese equities.
All right. Well, let's move back to bonds. In the first question, of course, you provide quite a bit of context around bond market volatility. I suppose the logical follow-on question there is, should investors be using the rebound in bond yields, long bond yields, to add to US and UK bonds at this point?
Yeah, it's indeed a very, very timely question. Let me start to cover the US side of the equation first. We find it actually quite notable that despite the recent upward pressure, the 30-year bond yields have not moved sustainably above their recent 4.8% to 5.1% range. So in the absence of any inflationary shock, we expect this cap to hold, and therefore creating opportunity for us to lock in yields on rebounds if the yields actually jumping towards 5% to 5.1% level. And for the 10-year part of the curve, it is currently trading within our 4.25% range, and we will be adding more bonds if yield rebound over 4.35%. As a reminder, our view remains that the U.S. government bond yields will edge lower, driven by our expectation of a soft landing for the U.S. economy, and especially if we look past today's the job opening numbers, ADP and JOLTS, actually turn weaker and shall make way for the Fed to deliver rate cuts in the upcoming FOMC meeting in mid-September. But of course, I think tonight's non-farm payroll and the coming CPI and PPI are also important data points for us to assess. Now, on the UK side of the equation, we remain tactically bullish. We believe the Bank of England will ultimately be able to deliver further rate cuts as growth and job creation are facing headwinds. But of course, inflation remains a concern there. The UK government also faces a more challenging fiscal outlook in comparison to the US, but such concern could lower maybe running up to the autumn budget, which will be released in November. So overall, we think a broader exposure to UK gilts and try to avoid excessive concentration in very long maturity in the UK gilts will make sense to us.
Thanks, Ray. I guess we can't end today's conversation without talking about gold, which has jumped quite notably in the last couple of days. Can gold prices extend their run?
Yeah, I think the view from us is that the technical pullback probably is more imminent because it's now in an overbought territory, especially after it has been broken out the range on the high side, which I think is around $3,440 per ounce. This is actually after a period of consolidation around this range and ultimately decided to move upward. But we think that we will actually use any pullbacks to add position into gold. From a technical standpoint, we think would adding on dips towards the support level at 3,365 per ounce would make sense, and that is also the level where the 50 days moving average is crisscrossing. So we'll continue to view gold as a core holding and believe that ongoing central bank demand and rate cuts pause back and demand for diversification would continue to benefit gold and can continue to support the gold prices.
All right. Well, thanks, Ray. I think we'll bring the conversation to an end today on that note. Thanks so much for taking the time to speak to our listeners. Top 3 takeaways from today's conversation. First, as you just heard from Ray, we would consider adding to gold on pullbacks. Because we expect the gains have room to extend. Second is that when it comes to long maturity bonds, we do expect the US 30-year in particular to ultimately be capped around 5.1%, so potential opportunity buy on rebounds, but for more diversified maturities in the UK. And finally, we do sort of prefer China equities, but we do prefer the offshore over the onshore, especially if we see policy tightening on the onshore equity market. So thank you very much for taking the time to listen in today. We hope you enjoyed the conversation, and we look forward to speaking with you again next week.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details, visit Market Views on the Go on our website or click the link in the description.